The high interest rate regime between 2011 and 2012 made it a nightmare to borrow from banks whose rates were above 20%. Easing inflation over the last 2.5 years has seen the central bank lower its lending rate from a high of 18% to 8.5% today. But banks have been rather slow to follow suit, maintaining an average lending rate of between 19 to 20%.
If you look at the income statements, they make most of their money from interest income, which is basically the loans that they lend out and the interest they charge on those loans.
The cost of credit has slowed down borrowing from the larger market of consumers, therefore affecting businesses which rely on funding from commercial banks. But this time around, analysts expect that banks will lower their rates sooner.
Some more focused on their cost-to-income ratio. They're realizing that this ratio for most of them are above 50%. So another way they're looking at of growing the bottom line is reducing the costs.
That means banks are exploring real estate, plastic money business, mobile banking, among other avenues which are long-term to reduce reliance on loans and the interest rates they charge on them. Analysts expect that banks will begin lowering their lending rates in the next 3 to 4 weeks to an average of between 13 and 14%. But this will still be too high for the retail customer, who may be forced to explore other sources of funds. For JSO at 7, I'm Bella Genga.